I think that anyone can own this ETF. Seriously, regardless if you're a dividend growth investor or even a hyper growth investor. And let me explain. This ETF holds over 100 of the best companies in the world. We're talking about blue chip dividend growth stocks, US based companies. And if you're a dividend investor, you already probably love this ETF and you own it. But if you're a growth investor, you need some diversification in your portfolio, especially if you're in all tech, because this ETF will easily do it for you. It takes all the work out of it for you. Just by owning this ETF, it'll add some diversification. So I like to build portfolios that have a blend of ETFs, dividend stocks, growth stocks, and even some spec stocks sprinkled in. I'm a huge fan of diversification. In fact, all of my retirement accounts are in ETFs. Today, we're going to break down SCHD. That's the Schwab High Dividend ETF. I'm going to show you what's in it, some performance metrics. Now, part of the reason I want to bring this to the channel, Costco just last night reported March sales results and they were down. Now, it doesn't have to mean anything, but oftentimes that means that the consumer is slowing down their spending. And there are more and more fears about a recession. I'm not here to spread FUD and tell you that's going to happen with certainty, but having a diversified portfolio will help you sleep better at night. If you own, for example, I see this on Twitter all the time. I'll see somebody post, here's my portfolio, and it has 6 cloud stocks, hyper growth stocks, burning cash. That's not a portfolio. That's an account that holds 6 stocks in it. A portfolio needs to have some diversification. You can't be in all one industry or just a handful of stocks in the same industry. And again, this ETF is going to take the hard work out of the equation for you. And you can see in the news, we are going to see parts of the economy break. Recession fears move back to the forefront of markets. We've had a sell-off over the last couple days.
Prices are still too high across many parts of the economy. We know that who feels it the most when the cost of rent and groceries go up.
To stop the out-of-control inflation caused by the out-of-control spending, the Fed steps in. The truth is that when your food prices go up over 20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch?
My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt.
If you have a basket of all spec stocks, you're not happy right now and you're probably stressed out. And if that's the case, that means you've built a portfolio that does not fit your risk tolerance and needs, and you should adjust that. This ETF can help you do that. And here's another headline. Layoffs are up nearly 5-fold so far this year. And I'm not discounting it at all. Look at the bottom here for tech. A staggering increase of 38,487% from a year ago. That's a huge number. The nice thing about owning SCHD, it doesn't matter if we have a hard landing or a soft landing. Sure, it can sell off, but it's not going to sell off like a hyper growth stock or a spec stock or a meme stock. So SCHD is a good target because it's flat so far in 2023. People have been selling these type of names, plus the banking industry's been hit. And so the NASDAQ has ripped so far in Q1 2023, and the SCHD ETF has been sitting flat. It's lagging the broader market. But look at this. It outperformed in the past year, gaining 3.6%. That might not sound like a lot, but when the NASDAQ is down, the QQQ is down 30% plus in the year, that sounds pretty good. Over the past 5 years, it's returned 73%, and over the past decade, 137% return. So if you look at the performance comparison against the VU, which is the S&P 500, on a 5-year return, it's actually outperformed. In total return, it's slightly underperformed. But here's the thing. If you're a growth investor, you're probably pretty heavy on tech. The VU is still going to have heavy weight in those mega cap tech stocks like Apple and Google and Amazon and so on. SCHD is going to help you balance that out because there's not as much overlap. So in other words, if you own a bunch of Microsoft and Apple, buying the QQQ or the VU is going to give you some overlap, which isn't necessarily a bad thing. But the SCHD will help diversify completely out of IT. And what I mean by that is diversify out of that mega cap tech that's so heavy in the S&P 500 and the QQQ and SCHD. So let's break it down and see what's in it. It's trading just under $73 a share right right now, it's down 0.09%. So information technology, it does have 12.49%, but likely in stocks that you don't own. Industrials is about 18%, healthcare 16%, financials 14%. You can see on here, consumer staples 13%, energy is about 9%, consumer discretionary 8%, communication services about 5%, materials 3.43%, and just a little bit of utilities at 0.28%. And then if you look at the industry exposure, I won't read through all this, but you can see what's on your screen. Pause it if you need to. So here are the holdings for SCHD as of April 5th, and there have been some recent changes. It's showing 104 holdings right now, which includes cash. AbbVie, number one, 4.27%. Of course, huge biotech, pays a nice dividend yield. You think Botox, you think Humira, and so on. Verizon Communications. Everybody knows what Verizon is, right? Cisco Systems, Pepsi, Chevron, Coca-Cola, UPS, Amgen, Texas Instruments, great company. Pfizer, Home Depot, Merck & Company, Broadcom, Lockheed Martin, BlackRock, ADP. These are solid blue chip companies across the board. This is Fidelity here, and it's a little easier to see. So I'm going to show you the entire basket in one snapshot for you. And I'm going to scroll through these. You can read what's in this ETF while I give some more commentary. The thing about SCHD, it's going to give you exposure to over 100 of the best companies in the world. Blue chip dividend companies that have dividend growth. And in most situations, you think of dividend growth, it's trying to outpace inflation. Now, when inflation's 7 or 8%, of course, that's not the case. But in normal situations, when the US inflation is 2%, this is going to pay you a dividend yield. So next, let's look at the dividend yield and see exactly what it pays as well as the expense ratio. So your distribution yield, TTM, is 3.61%. The 30-day SEC unsubsidized yield is about 3.5%. Expense ratio is 0.06. Now, that's not as cheap as maybe VU, the S&P 500 from Vanguard, but that's not a terrible expense ratio. For comparison, the QQQ charges 0.20%. So I know I went through that fast. So one more time, and this is going to help you kind of see it a little bit better. Percentage of assets there, you can see the ticker, you can see the name of the company. These are high quality companies, and it's not concentrated like a lot of ETFs are. There are a lot of holdings. There's a good balance here. You can see Best Buys and there's Snap. You can see lots of different companies that you know, Whirlpool, Western Union, Carter's. Now, some of these companies you might not actually want to ever own on their own, but to own them in the basket sort of hedges that risk. So I like this ETF, especially to diversify a portfolio. You think of a growth portfolio, this can be a core of any portfolio. So in conclusion, I think that any portfolio can own this ETF, SCHD. I prefer this under $70 a share, but it's still attractive even in the low 70s if you're a long-term investor, especially when you consider the dividend yield. What's great about this ETF is you can own this as a core, as a foundation in a portfolio, and you can sleep well at night, knowing that it's probably going to be worth more in a couple years, especially if you think 5 and 10 years out. So I encourage everybody to diversify in their portfolios. And if you can't buy the ETF, you can look at these individual stocks, find your favorite ones, and buy those individual stocks. If this was helpful, please subscribe. I'm trying to get this channel to 40,000 subscribers in 2023. Drop a like and a comment. Appreciate your time and attention. Have a great rest of your day. Take care.